It is December 24th, 2025. It is Christmas Eve. Most of the Western world is currently wrapping presents, preparing turkeys, or traveling to see family. Wall Street is technically open for a half day, but the trading floors in New York are ghost towns. The volume is supposed to be dead. The bankers are supposed to be in the Hamptons. Everything is supposed to be quiet. But I need you to stop what you're doing. I need you to put down the wrapping paper and look at the screen, because while the West was sleeping, the East just broke the financial system. Ladies and gentlemen, Asian guy here. We are not using hyperbole today. We are not using clickbait. We are looking at mathematical impossibilities occurring in real time. We are witnessing events that should not be possible in a functioning market. We are watching the global financial architecture crack in front of our eyes, and most people have no idea it's even happening because they're too busy shopping for last-minute gifts. At 3:30 a.m. Eastern Time, the Shanghai Gold Exchange, that's SGE for short, and the Shanghai Futures Exchange, SHFE, didn't just open their trading day like any normal morning. No, they detonated. They exploded. The price action that occurred in those first 30 minutes of trading wasn't just unusual. It was unprecedented. It was the kind of movement that makes risk managers wake up in cold sweats. We have been tracking a divergence between East and West for months now. We've been telling you, week after week, video after video, that this moment was coming. We told you that China was systematically draining the physical metal out of the Western vaults, while New York continued playing its paper games. We showed you the vault data. We showed you the export numbers. We showed you the mounting evidence that the two markets, the Eastern physical market and the Western paper market, were slowly drifting apart like tectonic plates before an earthquake. But what happened 3 hours ago is not a divergence anymore. This isn't two markets moving in slightly different directions. This is a full decoupling. This is the moment where the entire global pricing mechanism for silver, a mechanism that has existed for decades, that has survived multiple financial crises, that has weathered the collapse of currencies and the rise of new powers, this mechanism has finally, catastrophically, broken apart. I want you to look at this number very carefully. I want you to understand what you're seeing because the implications are absolutely staggering. $77.89. That is the closing price of silver in Shanghai today, converted to US dollars. Not yuan, not some theoretical number. Actual US dollars per troy ounce, 77.89. Now, I want you to look at another number. Look at the price on the COMEX in New York right now as I'm recording this, $72.23. Maybe it's even less by the time you're watching this video. Maybe it's 72 flat. Maybe it dipped to 71 and changed during the thin holiday trading. Do the math with me right now. Pull out your calculator if you need to. Take $77.89. Subtract $72.23. What do you get? $5.66 per ounce. Let that sink in for a moment. A $5.66 spread between the same commodity, the same metal, trading on two different exchanges on the same planet at the same time. In the history of the modern precious metals market, and I'm talking about the computerized, interconnected, globally arbitraged market that we've had since the 1980s, we have never ever seen a sustained spread like this between major exchanges. Never. Not during the 2008 financial crisis, not during the COVID crash, not during any period of extreme volatility or market stress. Historically, when you look at the difference between London prices, New York prices, and Shanghai prices, you're measuring differences in cents, maybe 50 cents on a normal day to account for time zones and delivery logistics. In periods of extreme volatility, maybe during a flash crash or a sudden geopolitical event, you might see spreads of $1 or even $2 for a few minutes, maybe 5 or 10 minutes at most before the arbitrage mechanisms kick in and the prices converge again. But $5.66, sustained for hours? This isn't a spread anymore. This isn't market inefficiency. This is a crime scene. This is evidence of a broken system. A $5.66 gap means that the global arbitrage mechanism, the invisible network of traders, algorithms, banks, and logistics companies that keeps prices aligned across different markets, has completely snapped. It's broken. The fundamental assumption that underlies all of modern finance, that prices for the same asset will converge across markets through arbitrage, that assumption is dead. Let me explain what should be happening right now under normal circumstances. If silver is trading at $72 in New York and $77 in Shanghai, creating a $5.66 gap, then every bank, every hedge fund, every sophisticated trading firm, and every algorithm on planet Earth should be doing one extremely simple thing: buying silver in New York at $72, arranging immediate transport to Shanghai, selling it there at $77.89, and pocketing the difference. That's $5.66 of pure risk-free profit per ounce. Multiply that by 100,000 ounces, and you've made over $500,000. Multiply it by 1 million ounces, and you've made $5.5 million in profit from a single arbitrage trade. This is what we call free money in the trading world. It's the easiest trade imaginable. You don't need to predict the future. You don't need to analyze fundamentals or charts. You don't need to worry about timing or sentiment. You simply buy low, ship, sell high, repeat. It's mechanical. It's guaranteed. It should be happening automatically. So why isn't it happening? Why is the gap not only persisting, but actually getting wider by the hour? Why, instead of converging, are these two prices moving further apart? There's only one explanation. And it is the one thing that the bullion banks, the central banks, and the financial authorities have been absolutely terrified of for 50 years. They cannot move the metal. They cannot execute the arbitrage because when they try to buy the silver in New York at $72, they discover something horrifying. It isn't actually there. The price that you see on your screen, that $72.23 on the COMEX, that's just a number. It's a paper price for a contract, a promise, an IOU. But when someone tries to convert that paper promise into actual physical silver bars that you can load onto a plane and fly to Shanghai, the system breaks down. The price in Shanghai, that $77.89, that's the real price. That's what people are willing to pay for actual physical, hold-in-your-hand silver that exists in the real world. That's the price of reality. The bridge between the paper world and the physical world has collapsed. And on this Christmas Eve, while families gather and presents are opened and carols are sung, the banks are trapped in the wreckage, watching their entire system crumble in real time. Before we dive deeper into the specific vault data, and I promise you, we have breaking news on the Asahi Vault that will absolutely shock you, we need to talk about something that most people, even experienced traders, don't fully understand. We need to talk about velocity. We need to talk about acceleration. We need to talk about how the speed of this rally is telling us something terrifying about what's coming next. Human beings are fundamentally not wired to understand exponential functions. Our brains evolved on the African savanna, where almost everything moved in straight lines. If you saw a lion 300 meters away yesterday and 200 meters away today, you could predict it would be 100 meters away tomorrow. Linear thinking. It kept us alive. But markets don't move linearly when they break. Markets move exponentially. And when you're inside an exponential move, your linear brain tells you it's impossible. It's a bubble. It has to crash because it simply cannot process the rate of change. Look at the timeline of this silver rally. Look at how the intervals compress as the price explodes. This is crucial data that reveals the true nature of what we're experiencing. To go from $20 per ounce to $30 per ounce, it took the market 145 days, almost 5 months. That's nearly half a year of grinding, daily price movements, consolidation, resistance, support levels being tested. It was slow. It was methodical. It was the kind of bull market that value investors love. Steady, predictable, allowing plenty of time to build positions. Then to go from $30 to $40, it took another 145 days. Same time frame, same grinding pattern. Still linear, still predictable. Bulls were happy but not euphoric. Bears were concerned but not panicked. The media barely noticed. It was still flying under the radar. But then something changed. The pattern broke. From $40 to $50, it took only 39 days, not 5 months, 39 days. That's a little over a month. Suddenly, the time required to move up $10 had compressed by almost 80%. The market was accelerating. The fuse had been lit. From $50 to $60, 12 days, not 39, 12, less than 2 weeks. Another 70% compression in time. The acceleration was accelerating. Traders who had been comfortably in control suddenly felt like they were riding a rocket that had just fired its second stage. From $60 to $70, 13 days. Basically the same as the previous move, but at a much higher absolute price. The velocity had stabilized at an insane level. We were in the parabolic phase. The chart had turned vertical. And now, right now, as I'm speaking to you, we are sitting at $72.23 in New York and $77.89 in Shanghai. We are entering the $70 to $80 zone. And based on the current velocity we're seeing, based on the order flow data coming out of Asia overnight, based on the volume and the momentum and the complete absence of sellers, this next leg of the rally, from $70 to $80, might not take 13 days. It might not even take 12 days. It might be finished before you eat your Christmas dinner tomorrow. We are in the parabolic phase. This is the part of the chart that looks like a vertical line shooting straight up. This is the phase where time stops being the relevant variable, and the only thing that matters is scarcity. This is the phase where the market is no longer asking, what will the price be tomorrow? But rather, is there any metal available at any price? Now, I need to get technical for a moment. I know some of you watching just want to see rocket emojis and hear me say, to the moon and all that. And trust me, we're going there. But if you want to truly understand why the banks are panicking right now, why there are emergency meetings happening at HSBC and JP Morgan and Deutsche Bank, even though it's Christmas Eve, you need to understand something called the swap rates. You need to understand the internal plumbing of the silver market. This morning, a critical metric flashed dark red. It's a metric that 99% of retail traders never look at, probably don't even know exists. But I guarantee you that every single risk manager at every major bullion bank is staring at this number right now. And they're sweating through their expensive shirts even though the air conditioning is on full blast. The one-year silver swap rate minus the US interest rate has plunged to negative 7.18%. Negative 7.18%. I need to explain what this means because it's absolutely critical. This number is telling us something profound about the state of the physical silver market. Usually, under normal market conditions, if you want to buy silver for delivery 1 year from now instead of buying it today, it should be cheaper to buy it for future delivery. This makes intuitive sense, right? Why? Because if you buy silver today, you have to pay for storage. You have to rent vault space. You have to pay for insurance against theft. You have to pay for security guards and armored transport and all the logistics of actually holding physical metal. All of those costs add up. So logically, if someone offers to sell you silver for delivery next year, you should get a discount. You should pay less than the spot price because they're bearing all those storage and insurance costs for a year. This normal state of affairs is called contango. It's the natural, healthy condition of a commodity market. But right now, the silver market is showing the exact opposite. The market is inverted. The market is in what we call backwardation. And it's not just a little bit of backwardation. It's super backwardation. It's extreme backwardation at negative 7.18%. What does this mean in plain English? It means the market is saying, I will pay you a 7% premium, I will pay you extra money to give me the metal right now, immediately, today, instead of making me wait a year. Think about how insane that is. Someone is willing to pay 7% extra to get silver today rather than getting it next year at a discount. That's like someone offering to pay you $107 for something that will cost $100 next year. They're paying you $7 extra just for the privilege of having it immediately. Why? Why would anyone do this? Because the industrial buyers, companies like Samsung, companies like Tesla, the solar panel manufacturers, the electronics firms, they do not believe the silver will actually be available in 2026. They're looking at the same data we are. They see the deficit numbers. They see the mine production is flat. They see the inventory is draining. And they're making a calculated decision. I don't care about the 7% premium. I don't care about the storage costs I'll incur. I need to get this metal into my warehouse, into my factory, onto my production floor right now, because if I don't secure it today, it might not exist tomorrow at any price. This negative 7.18% rate is a scream for help from the industrial supply chain. It's the sound of panic. It's companies realizing they've been operating on just-in-time inventory management, assuming silver would always be available, and suddenly discovering that assumption was catastrophically wrong. It's the sound of a supply chain snapping under stress. And here is the absolutely terrifying part for anyone who is short silver. For anyone who sold paper promises to deliver silver at lower prices. This spread isn't stabilizing. It's not bouncing back towards zero. It's plunging even more negative as we speak. Yesterday, it was negative 6%. Today, it's negative 7.18%. The desperation is increasing exponentially, just like the price itself. Let me put this negative 7.18% number in historical perspective, so you understand how unprecedented this is. In 1980, during the famous Hunt brothers squeeze, when three brothers from Texas tried to corner the silver market and drove the price from below $10 to $50 in a matter of months, we saw a backwardation during that event. Yes, the market inverted. But that backwardation was driven primarily by speculators, by three wealthy individuals using leverage to create an artificial squeeze. It was financial manipulation, not industrial necessity. In 2011, when silver hit its previous peak of about $48.70, we saw backwardation again during parts of that rally. But again, that was driven largely by retail investor FOMO, by people who remembered the Hunt brothers and wanted to get rich quick, by a wave of speculative fever. It wasn't fundamental, it was emotional. Today is completely different. Today, the backwardation we're seeing is not driven by speculators trying to make a quick profit. It's driven by industrial necessity combined with sovereign accumulation. It's driven by companies that need silver to build their products, combined with countries that need silver to back their currencies. These are buyers who cannot be scared away, cannot be shaken out, cannot be convinced to sell. The Hunt brothers could be stopped by changing the margin rules. The COMEX literally changed the rules of the game in January 1980, suddenly requiring much more cash to maintain futures positions, and the brothers couldn't meet the margin calls. Game over, price collapsed. Retail investors can be shaken out through volatility. You crash the price 20% in a week, create panic, and they sell. They're emotional. They're scared. They don't have deep pockets. You can force them out. But you cannot shake out Samsung. You cannot shake out a solar panel company that has a billion-dollar factory that will sit idle if they don't have silver paste for their photovoltaic cells. You cannot shake out an electric vehicle manufacturer who has promised their shareholders they'll produce 5 million cars next year. These are price inelastic buyers. They will pay $70, they will pay $100, they will pay $200. Why? Because without silver, they have no business. Without silver, their factories close, their workers go home, their shareholders sue them, their companies collapse. This is why the current situation is 10 times more dangerous for the banks than 1980 ever was. In 1980, the banks were shorting against speculators who wanted to get rich. Today, the banks are shorting against entities that must buy to survive. And that changes everything. Now, look at this from the perspective of the bullion banks themselves. The swap dealers, the market makers, the firms that are supposed to provide liquidity and facilitate trade. These banks, the HSBCs, the JP Morgans, the Deutsche Banks of the world, they exist to facilitate trade in the silver market. They make money on the spread between bid and ask. They make money by providing liquidity, by being willing to buy when others want to sell and sell when others want to buy. They rely on a stable, functioning swap market to hedge their exposure, to manage their risk, to ensure they don't get blown up by sudden price moves. When the swap rate crashes to negative 7%, that entire system breaks down, the liquidity dries up. The banks that normally lend silver to each other suddenly stop lending. The interbank market freezes, and suddenly these banks get stuck in the middle with massive exposure and no way to hedge it. Imagine you're a banker at one of these institutions. A client comes to you and says, "I need you to deliver 1 million ounces of silver to me in London next month." You agree, because that's your business. You don't actually have the 1 million ounces sitting in your vault. You never do. That's not how the banking system works. Instead, you assume you'll be able to borrow it from another bank through the swap market when the time comes, or buy it on the open market if needed. But today, when you go to borrow that silver through the swap market, the other bank says, "No, I'm not lending to you. I need my metal. I don't trust that you'll be able to return it. I'm keeping what I have." Suddenly, you're naked short. You have a delivery obligation you cannot meet, and you cannot borrow the metal to cover your position. You're trapped. And if you try to buy the 1 million ounces on the open market to fulfill your obligation, you'll drive the price up even further, causing losses on all your other positions. You're in a doom loop with no way out. This is why we saw the massive vault drains that we're about to discuss. The banks that do have physical metal are grabbing it and hoarding it for their own survival. They're not lending it, they're not swapping it, they're hiding it. The interbank lending market for silver is frozen solid like water pipes in a winter storm. And when pipes freeze, they burst. People keep asking me in the comments, "Asian guy, won't they just use the kill switch? Won't they just halt trading like they did in 1980? Won't they change the rules?" Listen carefully to my answer. They can halt the futures market in New York. Yes, they can press a button and stop the COMEX screen from blinking. They can suspend trading in the paper contracts. They have that authority, and they might use it. But they cannot halt the swap market. They cannot halt the physical market in Shanghai. They cannot halt reality itself. If they close the COMEX tomorrow morning, if they declare a trading halt or force majeure or whatever emergency measure they want to invoke, what happens? The negative 7% swap rate will just go to negative 10%. The price in Shanghai will go to $85, $90. The real market will simply bypass New York entirely and continue functioning in the East. New York is losing its relevance in real time. This negative 7.18% spread is the sound of the COMEX dying. It's the sound of the global pricing authority shifting from west to east. It's the death rattle of an empire. So let's take stock of where we are. Let's list the breaks in the system that we've identified so far. Break number 1. Arbitrage is broken. The $5.66 spread between New York and Shanghai proves that the global price discovery mechanism has failed. The fundamental assumption of market efficiency is dead. Break number 2. The swap market is broken. The negative 7% backwardation proves that the interbank lending system has frozen. Banks are hoarding metal instead of lending it because they don't trust the system anymore. Break number 3. The inventory is broken, and this is where we're going next. This is where the story gets even darker. Because it's one thing to see prices diverge on a screen. It's another thing entirely to see the actual physical metal vanishing from the vaults in real time. We just received the COMEX silver inventory update for December 23rd. The data was reported this morning, December 24th, while most Americans were still sleeping off their Christmas Eve parties or preparing their holiday meals. For the second consecutive day, we are seeing massive unexplained movements of metal out of the registered category. And for those who don't follow this closely, let me remind you what registered means. Registered inventory is silver that is officially available to settle futures contracts. It's the for sale pile. It's the metal that someone with a futures contract can actually take delivery of. It's the physical backing that gives the paper market its legitimacy. Today, or technically yesterday, December 23rd, but the data was released today. The total registered inventory on the COMEX plunged to 127,214,281 ounces. Now that might sound like a lot of silver to some of you. 127 million ounces sounds like an enormous number, but context matters. Let me give you context. At the peak earlier this year, COMEX registered inventory was over 160 million ounces. We've lost more than 30 million ounces from the registered category this year. That's nearly 20% of the deliverable supply gone. But what's happening right now isn't a gradual decline. It's not a slow leak. What we're seeing in the last 48 hours is an accelerating flood. It's a bank run. And I don't use that term lightly. Look at the breakdown by individual vaults. Look at which specific storage facilities are being drained. Asahi Refining. Asahi is a major refiner, one of the key players in the global silver market. Their vault in New York is a critical hub for liquidity, for deliveries, for the smooth functioning of the futures market. Overnight, and by overnight, I mean from the close on December 22nd to the close on December 23rd, 1,402,453 ounces were adjusted out of the Asahi vaults. Gone. Vanished. Removed from the for sale list. Over 1.4 million ounces of deliverable silver just disappeared from one of the most important vaults in the system. And Asahi wasn't alone. This wasn't an isolated incident or a reporting error or some administrative adjustment. JP Morgan vaults, 597,993 ounces withdrawn. That's nearly 600,000 ounces leaving JP Morgan's custody. CNT vaults, 228,780 ounces withdrawn. StoneX vaults, 24,984 ounces withdrawn. Add it all up. In total, millions upon millions of ounces are being physically removed from the COMEX system at the exact moment when the price is hitting all-time highs. At the exact moment when, under normal market logic, people should be bringing metal into the vaults to sell at these attractive prices. Think about the psychology of this for a moment. Usually, when any commodity hits a record high price, what happens? Sellers emerge. People who bought years ago at lower prices decide it's time to take profits. Miners increase production if they can. Recyclers work overtime. Supply comes onto the market to meet the high price. That's basic economics. That's how supply and demand curves are supposed to work. But today the price is at a record high, and the metal is leaving the system at record speed. The opposite of what should be happening is happening. This is what a bank run looks like, folks. It's not people in suits lining up on the street outside a marble building like in the old movies. It's armored trucks lining up at the loading docks of refiners and vaults. It's forklifts moving pallets of silver bars. It's owners of this metal, the smart money, the informed players, the people who understand what's really happening, saying, I don't trust your paper promise anymore. I don't trust your futures contract. I don't trust your system. I want my bars. Give me my physical metal. Give it to me now. Now, let's go back to that $5.66 spread between Shanghai and New York and see how all these pieces fit together into a nightmare scenario for the banks. You have to understand that the banks, the major bullion banks, the swap dealers, many of them are short in New York. They sold futures contracts. They sold promises to deliver silver at $65, at $68, at $70. They made those promises when they thought silver would stay suppressed, when they thought they could manage the price, when they thought the paper system would hold forever. Currently, the New York price is $72.23. So those banks that are short from lower levels, they are bleeding money. Every dollar the price goes up costs them millions. They're in pain. They're taking losses. But those losses, while significant, are manageable. They're within the realm of normal trading losses that a big bank can absorb. But here's the thing. The real price isn't $72. The real price, the price of actual physical silver that you can hold in your hand, is $77.89 in Shanghai. And if the New York paper market was forced to converge with the physical market, if the COMEX contracts had to be settled at the real global physical price, then those banks wouldn't just be bleeding. They wouldn't just be taking losses. They would be insolvent. They would be bankrupt. Their capital would be wiped out. So what are they doing? They're desperately trying to hold the New York price down. They're throwing every algorithm they have at the COMEX to keep the price at $72, or even push it lower if they can. They're spoofing. They're creating fake sell walls. They're doing everything in their power to maintain the illusion that $72 is the real price of silver. But the physical market in China is calling their bluff. China is bidding $77.89. And because China is bidding $77.89, offering nearly $6 more than New York, all the physical metal that was available in New York All those bars sitting in vaults, they're getting loaded onto planes and shipped to Shanghai. They're leaving the Western system and going east. This creates what we call a doom loop for the COMEX. Let me walk you through the mechanics of this doom loop, step by step, so you can see how it spirals out of control. Step 1. The banks suppress the price in New York to save their short positions. They manage to keep it at $72 through various means. Step 2. But suppressing the price in New York while Shanghai is at $77 makes the arbitrage gap wider. That $5.66 spread becomes a $5.66 profit opportunity for anyone who can actually move metal. Step 3. The wide arbitrage gap incentivizes every player who has access to physical metal to drain it from the COMEX vaults and ship it to China, where they can sell it for $6 more per ounce. It's irresistible profit. Step 4. As metal leaves the COMEX vaults, the registered inventory drops. We just saw Asahi lose 1.4 million ounces in one day. Step 5. When the vaults run dry, when there's no metal left to deliver against the futures contracts, the COMEX faces a default scenario. They can't fulfill their promises. The paper system collapses. We are watching the liquidation of the Western silver market happening in real time. This isn't a temporary dislocation that will fix itself. This isn't a minor inefficiency. This is a fundamental regime change. For 50 years, half a century, London and New York set the price of silver for the entire world. They told everyone what silver was worth. The LBMA fixing in London, the COMEX futures in New York, these were the benchmarks. These were the authoritative prices that everyone used. Miners sold based on these prices. Manufacturers bought based on these prices. Investors tracked these prices. The Anglo-American financial system controlled silver pricing. Today, December 24th, 2025, that authority has been revoked. It's been taken away, not through a vote or a treaty or a formal announcement, but through the raw mechanism of the market itself. Shanghai is now setting the price. Shanghai is saying silver is worth $77.89. New York has become a discount outlet store that is rapidly running out of stock. And when New York runs out of stock completely, it won't matter what price they post on their screen. A price without physical metal to back it up is just a number. It's fiction. It's a lie. And the banks are sitting in their offices on Christmas Eve. Those few risk managers who got called in despite the holiday, who are staring at emergency dashboards, who are trying to figure out how to manage this crisis, they're looking at a $5.66 spread that they cannot close. They're looking at a negative 7.18% swap rate that proves they have no metal available to lend. They're looking at an Asahi vault report showing 1.4 million ounces walking out the door in a single day. And they're realizing they are completely, utterly, hopelessly trapped. Now we need to talk about the why behind all of this. We need to get deeper into that negative 7.18% number and understand what it really means. Because if you're a casual investor watching this, that number might still look like technical gibberish. But if you are a bullion banker at HSBC or JP Morgan or Scotia or Deutsche Bank, this number looks like a death sentence. It looks like the end of your world. This is the 1-year silver swap rate minus the US dollar interest rate. And I know swap rates sound boring. I know most people would rather watch paint dry than learn about the intricacies of commodity swaps. But today, December 24th, 2025, this rate didn't just move a little bit. It didn't just fluctuate. It collapsed. It fell off a cliff. And what this indicates is that the internal plumbing of the silver market, all those invisible pipes and gears and mechanisms that keep the machine running smoothly, that allow silver to flow from mines to refiners to manufacturers to investors, all of that has stripped its gears. The machine is broken. Let me explain this concept so simply that a 5-year-old could understand why the banks are terrified right now. In a normal, healthy, functioning commodity market, silver for delivery in the future, let's say delivery 1 year from now, should be more expensive than silver for delivery today. Not less expensive, more expensive. Why should future delivery cost more? 3 reasons. Reason 1, storage costs. If you buy silver today and take physical possession, you have to store it somewhere. You need to rent vault space. Professional vault storage isn't free. You might pay 50 cents per ounce per year, or even more depending on security levels and insurance. That cost has to be factored into the future price. Reason 2, insurance. Your silver could be stolen, your vault could be robbed. You need insurance against that risk. Insurance costs money. That cost gets added to the future price. Reason 3, opportunity cost of capital. If you spend $10,000 buying silver today, that's $10,000 you can't invest elsewhere. You can't put it in bonds earning interest. You can't put it in stocks potentially earning dividends. Your capital is locked up in metal. That opportunity cost should be reflected in a higher future price. So logically, mechanically, economically, the 2026 delivery price should be the spot price today plus storage plus insurance plus opportunity cost. This is the natural, healthy state of a commodity market. This is called contango. When you see a normal contango curve, you know the market is functioning properly. But look at the silver market today. Look at what's actually happening. The market is doing the exact opposite of what it should be doing. The market is currently in a state where it will actually pay you a premium, to wait and take delivery later instead of taking delivery today. The market is saying, if you promise not to take the silver today, if you agree to wait until 2026, we will give you a 7% discount off the current price. This is completely backwards. This is what we call backwardation. And a backwardation of 7.18% isn't a small anomaly. It isn't a temporary blip. It's not a rounding error or a data glitch. It is a scream of absolute desperation from the physical market. What this means in plain English is that the demand for immediate physical possession of silver is so violent, so overwhelming, so desperate, that buyers are willing to pay a massive premium just to have the metal in their hands, right now, today, immediately. They don't care about getting a discount next year. They don't care about saving money on storage. They don't believe the metal will even be available next year at any price. They need it now. So who are these buyers paying a 7% premium to get metal today instead of waiting? It's certainly not retail investors buying 10 or 20 ounces for their personal collection. Retail investors don't move markets. They don't create backwardation. They're not big enough. No, the buyers creating this desperation are the industrial giants, the companies that use silver as a raw material in their manufacturing processes, companies that cannot function without silver. It's the solar panel manufacturer who has built a billion-dollar factory that runs 24 hours a day, 7 days a week. That factory has fixed costs, labor costs, equipment costs, debt service. If they run out of silver paste for their photovoltaic cells, the entire factory stops. The production line halts. Every day of stock production costs them millions of dollars. So they look at the 7% premium and they don't even hesitate. They pay it, gladly. Because one day of stop production costs far more than 7%. It's the electric vehicle battery maker who has contracts with automotive companies who has promised to deliver 100,000 battery packs this quarter. If they can't deliver, they breach their contracts, they pay penalties, they lose future business, their stock price crashes. They need the silver. They'll pay whatever it takes. It's the electronics firm that needs silver for circuit boards, for contacts, for connectors and everything from smartphones to servers to spacecraft. This negative 7.18% rate is telling us something absolutely critical. The industrial supply chain is broken. The smooth flow of silver from mines to refiners to manufacturers has been disrupted. The factories are now so desperate for metal that they're raiding the COMEX vaults directly because they cannot get silver through their normal supply channels anymore. We have moved from a speculative mania phase, where people buy because they think the price will go up, to a supply crisis phase, where companies buy because they have to, because their survival depends on it. And here's why this is so much more dangerous than previous silver rallies. Let me give you a historical perspective on why this current situation is 10 times worse than anything we've seen before. In 1980, during the famous Hunt Brothers squeeze, we did see backwardation in the silver market. Yes, the market inverted. The spot price was higher than the futures price, but that entire event was driven by three brothers in Texas, Bunker Hunt, Herbert Hunt, and Lamar Hunt, buying massive quantities of futures contracts. It was three wealthy individuals using extreme leverage trying to corner the entire silver market. It was financial manipulation. It was speculation on steroids. The Hunt brothers could be stopped, and they were stopped. The COMEX changed the rules in January 1980. They implemented Silver Rule 7, which suddenly required much higher margin, much more cash, to maintain futures positions. The Hunts couldn't meet the new margin calls. They were forced to liquidate. Game over. The squeeze collapsed. Price fell from $50 to $10 in months. In 2011, when silver rallied to its previous peak, around $48.70, we saw backwardation during parts of that move as well. But that rally was driven by retail investors, by the general public getting excited about precious metals during the aftermath of the 2008 financial crisis and the Federal Reserve's quantitative easing programs. It was FOMO. It was fear of inflation. It was everyday people buying silver eagles and silver maple leafs because they were scared about the dollar. Retail investors are emotional. They can be shaken out. You crash the price 20% in a week, create some scary headlines, trigger stop losses, and they panic sell. They don't have staying power. They get scared. The 2011 rally died when JP Morgan and other banks orchestrated a series of coordinated sell-offs and margin hikes that scared retail investors out of their positions. But today is completely, fundamentally, categorically different. Today, the backwardation we're seeing isn't driven by speculators trying to get rich quick. It's not driven by retail FOMO. It's driven by industrial necessity combined with sovereign accumulation. It's driven by companies that need silver to manufacture their products, combined with countries that need silver to back their new currency systems. These are buyers who cannot be scared away. You can't shake them out with volatility. You can't convince them to sell. They're not trading. They're not speculating. They're securing their operational future. The Hunt brothers could be stopped by changing margin rules because they were leveraged speculators. Change the rules, blow up their leverage, they're done. Retail investors can be shaken out through volatility. Drop the price 20%. They panic, they sell, rally over. But you cannot shake out Samsung. You cannot shake out a company that has spent 5 years developing a new solid-state battery technology that requires 1 kilogram of silver per vehicle, that has built new factories to manufacture these batteries, that has made billion-dollar commitments to automotive partners. You cannot convince them to take profits or wait for a better entry. They need the metal or their entire business model collapses. You cannot shake out a solar panel manufacturer who has contracts to deliver panels next quarter, who needs silver paste for those panels, who faces massive penalties if they can't deliver. These are what we call price inelastic buyers. They will buy at $70. They will buy at $100. They will buy at $200 if they have to. Why? Because the alternative is worse. The alternative is their factories sit idle. Their workers go home. Their contracts are breached. Their companies fail. The cost of not having silver is higher than any price they might have to pay for silver. This is the nightmare scenario for the short sellers. When you short something, you're betting the price will go down so you can buy it back cheaper later. But what if you're short against buyers who must buy regardless of price? Buyers who are literally price insensitive? You're trapped. There's no exit. You either cover your short at whatever price they demand, or you default. Those are your only options. Let's look at this situation from the perspective of the bullion banks themselves, the market makers, the swap dealers, the institutions that are supposed to provide liquidity in the silver market. The bullion banks exist to facilitate trade. They make money on the spread between bid and ask. When a manufacturer wants to buy silver, they go to a bullion bank. When a miner wants to sell silver, they go to a bullion bank. The bank stands in the middle, takes a small cut on each transaction, and everyone's happy. In normal times, it's a good business. Low risk, steady profits. These banks rely on a stable, functioning swap market to hedge their exposure and manage their risk. If a bank sells silver to a client but doesn't have the physical metal immediately available, they can borrow it from another bank through the swap market, or they can hedge their exposure with futures contracts. The system works because there's trust, there's liquidity, and everyone plays by the established rules. When the swap rate crashes to -7%, that entire system breaks down. The trust evaporates, the liquidity disappears. The banks that normally lend silver to each other through the swap market suddenly stop lending. Why? Because they don't trust they'll get the metal back. They don't trust that their counterparty won't default. They don't trust the system anymore. The interbank lending market for silver has frozen. It's like the credit markets in 2008 when banks stopped lending to each other overnight because they didn't know who was holding toxic assets. The same thing is happening now in the silver market. Imagine you're a risk manager at one of these banks. A client, maybe a big manufacturer, maybe a wealthy family office, comes to you and says, "I need you to deliver 1 million ounces of silver to me in London next month. Can you do it?" In normal times, you'd say yes without hesitation. You don't have 1 million ounces sitting in your vault. You never do. That's not how banking works. But you know you'll be able to borrow it from another bank when the time comes, or buy it on the market, or lease it, or whatever. You have options. The system is liquid. It's not a problem. But today, when you go to borrow that 1 million ounces through the swap market, the other bank says, "No, absolutely not. I'm not lending to you. I need my metal for my own obligations. I don't trust that you'll be able to return it. I'm keeping what I have." Suddenly, you're naked short. You've made a promise to deliver metal that you don't have and can't borrow. You have a legal obligation you cannot fulfill. You're trapped. And if you try to go into the open market and buy that 1 million ounces to cover your obligation, you'll drive the price up even further. Your buying will push the market higher, creating losses on all your other short positions. You'll create a feedback loop of rising prices and mounting losses. You're in a doom loop with no way out. This is why we're seeing the massive vault drains. The banks that do have physical metal are yanking it out of the shared pool and hoarding it for their own survival. They're not helping their competitors anymore. It's every bank for itself. The interbank cooperation that used to exist has collapsed. The system is fracturing. And this brings us to the question I keep seeing in the comments, the question everyone's asking. Asian guy, won't they just use the kill switch? Won't they just halt trading? Won't they declare force majeure like they did in 1980? Won't the regulators step in and save the banks? Well, let me be very clear in my answer, because this is crucial to understand. Yes, they can halt the futures market in New York. They have that authority. The COMEX can suspend trading. They can declare a market emergency. They can restrict positions to liquidation only, like they did to the Hunt brothers. They can press the button and stop the paper market from functioning. But here's what they cannot do. They cannot halt the swap market. They cannot halt the physical market in Shanghai. They cannot halt industrial demand. They cannot halt reality itself. If they close the COMEX tomorrow morning, what happens? Does silver stop existing? Do the factories stop needing it? Does Samsung say, oh well, I guess we don't need silver for our batteries anymore? Of course not. The negative 7% swap rate will just go more negative. It'll go to negative 10%, negative 12%. The desperation will increase. The price in Shanghai won't stop at $77.89. It'll go to $85, $90, $100. The physical market will keep functioning in the east while New York is frozen. The real market will simply bypass New York entirely and continue operating where the metal actually exists and where the buyers actually are. New York is losing its relevance in real time. The COMEX is becoming irrelevant. This negative 7.18% swap rate is the sound of the COMEX dying. It's the sound of 50 years of Western pricing authority coming to an end. It's the sound of the global financial architecture shifting from west to east. So let's summarize where we are. Let's list all the system breaks we've identified in this analysis so far, because understanding these breaks is crucial to understanding what comes next. Break number 1. Global arbitrage is broken. The $5.66 spread between New York and Shanghai that has persisted for hours proves that price discovery mechanism connecting global markets has failed. The fundamental assumption that underpins all of finance, that identical assets will trade at identical prices across different markets due to arbitrage, that assumption is dead. Break number 2. The swap market is broken. The negative 7.18% backwardation proves that the interbank lending system has frozen. Banks are hoarding metal instead of lending it to each other because trust in the system has collapsed. Break number 3. The inventory is broken. And this is where things get really dark. This is where we see the physical evidence of the panic. We just received the COMEX silver inventory update for December 23rd. The data was published this morning, and what it shows is genuinely shocking, even to those of us who have been tracking this situation closely for months. For the second consecutive day, not the first day, the second consecutive day, meaning this is an accelerating pattern, we're seeing massive unexplained movements of metal out of the registered category. The total registered inventory has plunged to 127,214,281 ounces. That's the total amount of silver officially available to settle futures contracts across all COMEX vaults. Now, to give you perspective on how much metal has vanished, at its peak earlier this year, COMEX registered was above 160 million ounces. We've lost over 33 million ounces from that peak. That's over 20% of the deliverable supply gone, vaporized, removed from the system. But what's happening right now in these last 48 hours isn't a continuation of a slow decline. It's an acceleration. It's a stampede. It's a panic. Look at the breakdown by vault. Look at the specific numbers coming from each storage facility. This is where the story becomes undeniable. Asahi Refining, one of the premier refiners in the world, a crucial player in the silver supply chain, saw 1,402,453 ounces withdrawn from their New York vaults overnight. Over 1.4 million ounces just walked out the door of one of the most important storage facilities in the entire COMEX system. JP Morgan, the bank that everyone watches because of their historical manipulation in the silver market, their massive short positions, their pivotal role as both a major bank and a major commodity trader. JP Morgan saw 597,993 ounces leave their vaults. Nearly 600,000 ounces gone from JPM's custody. CNT Depository lost 228,780 ounces. StoneX Vault had 24,984 ounces withdrawn. When you add up all these numbers, you're looking at millions upon millions of ounces being physically removed from the COMEX system in a 48-hour period. And this is happening at the exact moment, the precise moment, when the price is hitting all-time record highs. This is backwards. This violates everything we know about market behavior. When any commodity hits a record high price, sellers should emerge. People who bought years ago at lower prices should be bringing their metal to market to cash in on the high prices. That's what always happens. That's basic supply and demand. But today, the opposite is happening. The price hits records, and instead of supply coming onto the market, supply is vanishing from the market. The metal is leaving at the fastest rate we've ever seen. This is what a bank run looks like. Not the old-fashioned kind with people in lines outside marble buildings. This is a modern bank run. It's armored trucks at loading docks. It's forklifts moving pallets. It's owners of metal saying, "Your paper promises are worthless. Give me my bars. Give me my metal. Give it to me now, or I'm suing you." We are witnessing history, And most people have absolutely no idea it's happening because they're too busy wrapping Christmas presents. I am John A.G. Thank you for being part of this movement. Remember to like and subscribe.